All right, what happened this last week? We'll jump into markets. We'll see where interest rates may be headed. We'll look at DR Horton, and we'll look at potentially unraveling of the AI trade and where that might end up. So with that, let's jump in. So last week, we got the FOMC meeting minutes. Really not a lot. We got unemployment, but it is a couple of months old. We actually got the September unemployment report that reflected positive job growth. So we had some revisions downward, but we did have 119,000 jobs added. Going down to here, let's look at July was revised down by 7,000 and August was revised down by 26,000. That put August jobs report actually at a negative growth of 4,000 and together combined 33,000 lower than previously reported. Jumping into a little bit further detail, take a look at the unemployed. We have 219,000 more unemployed people, but we had a 470,000 increase in the labor force. I'll go into just a little bit of detail. It is old, but there's still a couple of interesting points in here. So I'm going to go down. Let's take a look at the distribution of workers. Those with less than a high school diploma actually increased a little over 200,000. Those, they were high school graduates but no college, actually decreased. I don't know if there's a surprise here. Maybe some kids are going back to school, so I don't see this as a real surprise given the timing of this. Some college, like an associate's degree, a little bit of an increase here, so that's a positive. This one with the bachelor's degree, so your higher skilled workers, higher paid workers, more money going to the economy. I think that is pretty flat. Going down further, look at your foreign born. So think immigration policy. So your civilian labor force actually dropped by 700,000 from one year to the next. The unemployed remained relatively flat. So just something to keep an eye on. We are seeing more workers going out of the economy. This is going to have an effect on prices. Specifically, think of construction, farms, food, where you have these immigrants working in those type of categories. It's going to affect housing prices potentially because you have fewer construction workers, and then you're going to have potentially like fruits and vegetables like out in California. That's going to have an effect on prices. So it may not have, and not to get political, but on one side of the equation where you're having an effect on prices and then you have removing of money from the economy, is that really going to help GDP or not? Is it going to really help growth? And there are studies out there that show that removing a lot of people at this scale has a negative effect. Not to get political, but there will be some economic effect on this. There are something to the effect of 2 million people have either been deported or have self-deported. And that's a lot. That's a lot of people. How does it affect rent? How does it affect housing prices? And then you've got the whole construction thing that I just mentioned about. Take a look at full-time, part-time workers as well as multiple job holders. Take a look at full-time. This is a good number from one year to the next. You've got 134 to 135.7, so 1.5 million additional full-time workers. That's a good sign. And then part-time workers really flat. This is not a bad picture right here. A little bit concerning there, though, here is look at multiple job holders. 8,600 to 8,700, so 150,000 more people on this. So this is one of the highest, 8.8 million people seasonally adjusted. This is non-seasonally adjusted. This is seasonally adjusted. And you can see going back several months, you did have one here at 8.8, but this is the second highest. So is that a sign of strain on households where more people need to hold multiple jobs just to make ends meet? Don't know. Something to keep an eye on. Let's go down a little bit further. Non-farm payrolls. This is 119,000 jobs added. Let's see where they were added or removed from. So goods producing, only 10,000 job ads. That's interesting. You have 19,000 construction workers added. Manufacturing. So with the policy of all the tariffs, where's the manufacturing? Manufacturing jobs has been declining. We'll look at that on another chart here, but another -6 on that. So manufacturing jobs aren't coming in. Take a look down here on the private service side. So first one we looked at was goods. Next one is services. 87,000 job ads in services. So retail trade, 13.9. Transportation and warehousing, big drop off here, 25,000. IT, 0. Professional and business services, so think of these are higher skilled workers, -20, not good. This is one I really like to look at, is under administration. So think of recruiters and employment, admin and things like that. So here's your admin, -18. Office admin, negative 2.7. Employment services, so your recruiters, down negative 17. That means companies aren't hiring. You can just see that. This is going to be a leading indicator of what's coming up. You have like giant layoffs and stuff that you've heard about. Verizon let go 13,000 people this week. Employment net down negative 15. Under healthcare, this and education, this is where you're seeing the ads. 59,000 here. And under leisure and hospitality, 47,000 here. So think of your arts, entertainment, food, theaters, things like that. That's where you're seeing some job ads. There's some discretionary income going there. And then you got healthcare, of course. You got an aging population with baby boomers. So that makes sense. The rest of this, if you were to take that out, you would have had negative jobs. This is concerning to me, so keep an eye on this one. Overall, it was a good jobs report at the headline level, but when you look underneath the covers, maybe not so good. Again, this is a couple of months old, so it doesn't really matter. We get the November jobs report. They're going to extend the timing of the sampling up until a couple weeks into December, so we actually get the jobs report December 16th. I'm really suspect on that one. I kind of wonder if it's going to be garbage, only because even though they're extending the time frame, is there going to be a big sampling error? I'm not going to put a whole lot of stock in that one because the sampling error could be large if they don't get all the companies that they have sampled in the past or all the people that they've sampled in the past. Take it for what it's worth. Again, I'm not going to put a lot of stock in that one. Let's look at a chart. This shows of all of the workers by percentage of growth since the beginning of 2024. And you can see that we saw the temp workers, that's continuing to go down. Manufacturing, look at this, going back to the first of the year. Here it is. And we have negative manufacturing. So the manufacturing jobs that we were supposed to be getting back is not occurring yet. And I don't know that it will occur because we've got a 4-year administration. And if you're trying to move all these jobs back, that takes several years. And why would companies, even though you have some commitments, why would you have a lot of companies at the broad scale bringing everything back when everything can change in just a couple of years? It's very expensive to move things back. So you may see let's just let it ride. And that's what I'm seeing here. Manufacturing continuing to go down. I don't see the tariffs as really helping manufacturing. Look at transportation. Pretty flat and then decreasing. Retail's going up, so there's still spending going on. We get retail sales this week. Take it for what it's worth. I don't know how much that I'd put a lot of stock in it. Construction is pretty flat. We went down and then it increased. And then leisure hospitality, that's the good category. People are spending money in this, and then government's pretty flat as to be expected. All right, so enough about unemployment and manufacturing and my soapbox there. Let's go into the market. So here's where we are. Look at this long-term trend channel that we've had. Is it breaking down? I don't know yet. I've been telling everyone to look at the 65, 6600 mark. That is where a decent support is. It has bounced, and you can tell. Let me just draw a line here. This is that number here. That is your strong support. If it breaks down here, you can expect the market will probably retest the 200-day moving average. You might drop down to 6,200. If this holds, which so far so good, we will see a rally. I still expect that it will hold, and then we'll see a year-end rise. Now, 7,000 is a lot further away than it was. We've got about, 6% to go to hit 7,000. Month and a half to go up 6%. It's possible, but volatility's back, so that's been fantastic as an options seller. Okay, so S&P for the week down 2%. I did add this new one. This is RSP. So you have the S&P 500, which is primarily it's a market cap weighted. So think of a company like Nvidia. They're worth a few trillion. Was it $3 or $4 trillion? So they're going to have a bigger weight than the small guys. So when you have the Mag 7, those 7 companies, Microsoft, Amazon, Tesla, a couple others, they're going to have a huge impact. When they fall, the market's going to fall. What this ETF is an S&P 500 equal weight. So it doesn't matter if Nvidia is giant and they're going to have the biggest stake in the S&P 500. This ETF is more fairly balanced across. So I went ahead and added this because you had a big AI trade pullback this week, and that's what caused the market to fall 2%. It did, in sympathy, bring down the rest of the troops, but that only was down at 0.84. So we're going to keep this one in here because it's a little bit more fairly balanced. And then you've got IWM. I've talked about this one before. This is the one that I've been waiting to get put to me. Let me show you that real quick, and then we'll come back to this. So here's IWM. My indicator's flashing a strong buy signal now. Each time when it drops and then it goes up, drops and it goes up, I'm selling puts, and I kept lowering my puts, and I actually lowered my puts to 231. And I thought, well, I think I mentioned that last week. I'll go ahead and wait till they get assigned. Then it went up. I went ahead and closed those for a profit. When the market pulled back, I believe it was on Thursday, it pulled back a lot. It was actually up 2% and then dropped like 3% from that peak in the morning. When it fell, IWM went down to 231, and that was a perfect time to get in. So I've been having a position all along, and then what I ended up doing is I sold more puts. I actually tripled the amount of puts because look at this drop here. You're at 10% off. 10% off of its high, so why not sell more puts? And I ended up selling more puts at 221. So you know what? All right, in that case, let them get put to me. And I tripled my position here. Then the very next day, it went up, and I ended up collecting most of the premium, and I just went ahead and closed that position, waiting for IWM to pull back. I will see what happens here. This volatility in IWM has been very profitable, just waiting and moving things down and pushing it forward. I'll close it for a profit, move it down, push forward. If you wanted a little bit more insight, I do have a couple of training videos on selling puts. So that's been a pretty good strategic play. I don't have a position right now in IWM. I will open up one if the market pulls back, and then I will probably sell that for December 5th. Rather than this Friday, I'll sell it for December 5th. All right, let's go back to the rest. TLT had a decent week, 0.71. This is your 20 and 30-year bonds. Housing was on fire, actually, the latter half of the week. I think it was on Friday. XHB actually went up like 4%. It had pulled back, and that was another one I've been selling puts on. So collecting good premium while the volatility is in. Volatility is very expensive right now, which is fantastic. Utilities not so great. Data centers still having a sharp pullback because of the AI trade. There's a big narrative out there that maybe these companies are in a circle and they're buying services and product from each other, and people are starting to question it. You've got, Michael Burry, the big short guy. He had a huge position in Palantir, and I forget the other one. Big short position, and everybody laughed at him when it got posted. And look who's laughing now. Palantir is down like 30 or 40%. AG&C had a good week. This one is going to be one of those that just ride. They'll go up and down. They're a great company for me to sell puts on as well as collect dividends. They have right now a 14% dividend, and they've had that for several years. 12 cents per share. So that's why AG&C is one of my favorite. And then live cattle continues to fall. I've been waiting for it to rise, but I think I may have missed the big short on cattle. Looking at the week a little bit more in detail. This is just 1 week, 5 minutes. And this is the big day everybody was waiting on. It was pretty much flat for the first part of the week. And then Wednesday night, Nvidia reported earnings. So when the market opened up on Thursday, look at that. The market was actually up 1.5%. Finally got up to 1.91%. Huge increase. I did not play Nvidia from an earnings crush. I'll get into that in a little bit. I actually chickened out. I would have done very well. Had I played it, it was a perfect candidate. Everything lined up, but I did not play it. And that's okay. So look at this. From the peak on Thursday morning at 9:45 down to the bottom at the end of the day. 3.5%. What a move. It was one of the most spectacular moves of the year. Down 3.5% from its peak. And then, so this is the unraveling of the trade. Everybody's starting to I don't know so much. That AI, everything's overpriced. We'll see what happens. We'll watch the narrative. I don't care. I don't really play directional prices. I play volatility. So it doesn't really matter to me, and I'll wait, and maybe NVIDIA will print a buy signal with my indicator, and then maybe I'll buy it. We shall see. And then the rest on Friday, not much. We ended up having a decent day. I want to say it was like 1% up from here. And then Friday afternoon it fell. So I don't know where we're going from here. We've got a strong support. I think it'll bounce, but we shall see. Let's look at some of the other indicators and see what some of the other signals are. Put call ratio. This one is still on a sell signal. This is probably one of my favorite signals. It is a contrarian indicator. And so right now people are buying a whole lot of puts because they're scared. and they don't know where the market's going, so they're paying a whole lot extra. When this rolls over, like it did here and here, when that finally rolls over, that'll be the buy signal. And then this, from a market breadth indicator, your new highs, new lows, you're still printing a lot more new lows than you are new highs. So that is a sell indicator. From a MACD perspective, we're definitely on a sell. Once this signal line crosses, we will get a buy signal. That'll probably line up a little bit with our other indicators, but for right now, that's on a sell. And when you look at your 50-day stocks above your 50-day moving average and 200-day moving average, right now we only have 37% of stocks above their moving day average. If this gets down much lower and you're starting to get into that 20-25% range, that'll be a strong buy, and it'll probably be about the same time the put-call ratio moves over. Let's look at VIX. And VIX is deteriorating. This is a negative for stocks. So all in, stay neutral. This is a perfect time to be selling volatility. My favorite, and I have positions on this, SPX or SPY, whichever one you want to trade. What I like to do in times like this, when volatility, what is this, 20-something%, you can go out 30 to 45 days and you can sell straddles. And that is, you go sell a 20 delta put and a 20 delta call. Basically, where that puts you is you're going to be at 635 on SPY. Or 6,400, something like that on the SPX. And on the upside, you're going to be up to 6,900 or 690 on the SPY. That means as long as you're selling those, and then you buy a 16 delta or 15 delta put and call to protect you even further. But with that kind of premium, what that does, if you just did one of those on SPX, your position is probably like, call it somewhere between a $6,000 and $10,000 position. You just do one of those. You will have a theta decay of around $50 to $75 per day. That means every day you can expect to see, as long as everything else remains neutral and you don't see this spike up even more, you will make about $50 to $75 a day. As this part comes down, and VIX will fall, because once the market starts finding neutral and saying, hey, things aren't that bad, and it starts going back up even just a hair, then volatility collapses. This falls like you see it here. This will eventually fall, and when it falls hard, it falls fast. The Vega component of your straddle then collapses because you're selling Vega and you're selling theta, which is your volatility and your time. Time's always going to work in your favor, but Vega is your volatility. When that collapses, not only will you make the $50 to $75 a day, you might even make a little bit more than that as Vega falls. Now, you can't just set it and forget it. You can't sell a 30-day or a 40-day straddle. You've got to watch it and you've got to hedge it. And if the market shoots up very fast, then you close out your bottom part for profit and you roll it up. Or if it falls too fast, you close that out and move that down. This is one of my favorite trades, especially when volatility is high, because it works in your favor. You don't do this if volatility is super low because you can't get the premium. And this one actually works. Probably one of the best strategies that I know of. So, again, just go Google it, go AI it, and look up a 30 to 45 day straddle that you sell. It's called an iron condor is the technical name. You can sell a straddle just by itself, or you can protect it, and then that's called an iron condor. Go look up selling iron condors. I also have a video on it. Let me know if you want a little bit more detail after that. Enough about straddles. Let's see where rates are. So I talked about this last week. I was hoping, remember I bought it back here and then it went up, sold it, came back down, and I was able to get back into it. Perfect. I got back into it, and now look. What this means is this is a 13 basis point move. So for next year, next December, it is pricing in right now 3 cuts. It's now beginning to price in back in already a half of a cut at 13 basis points. 1 cut's worth 25 basis points. This is what I said was going to happen. And it'll go up. It'll go up higher because there are things like weakening employment, which we looked at in those certain sectors. The headline number, not so much, but at certain sectors it is. And I think there's some more things, and I'll get into that in just a second. So here we are. Now we have a 71% chance of a December cut. That will depend on what the unemployment report shows on December 16th. It's going to be garbage. I'm not going to buy a whole lot into it, but it'll be data. It'll be a valid data point, and that will determine whether we get a rate cut or not. If it shows strong, then you won't get a cut. If it shows weak, you'll definitely get a cut, and you'll see this all along the curve move. Look at next year. So you got one cut in December priced in, then you got 2, 3, and this is that fourth cut now that's starting to be priced in, because this number here, 12.9, this is what you're buying here. All right, so I think this has more room to go at 12.9. I'm going to put this in this camp and go another 25 to 30 basis points. You might get lucky and even get down here. And that, because remember, they're buying a ton of T-bills because they're stopping quantitative tightening. But not only that, take a look at this. These guys here are the runners up. I've been talking about Jerome Powell leaving in May. So he leaves right here. These are the runners up. This is who Trump is interviewing, and Besant and whoever else does the interviews. You got Warsh, you got Hassett, Waller, Bowman, and Reeder. So who's the runners up? I don't think Bowman is going to get it. She's a current Fed governor. While she's the top 5 candidate, she's probably not going to get it because Trump wants to lower rates. He's been talking about lowering rates 200 or 300 basis points, right? Bowman has been a hawk in the past, meaning keep rates higher. And now she's all of a sudden she's switching her tune because now she's a candidate. So the last couple of times, yes, she has voted for a cut, but she's, call it I wouldn't say wishy-washy, but maybe she's being wishy-washy now because she wants that promotion. So she's now siding on the camp of, hey, we need to do cuts. So for that reason, I think she's out because of her recent shift to being dovish. Waller, same thing. He's been a critic of the Fed, and he's going back and forth. Sometimes he's for cuts, sometimes he isn't. This guy, he's dovish. This guy's dovish, but I don't think they have the experience that this guy does. This is Rick Reeder. This is, if you were going to ask me, we should find out by the end of the year, this is the guy I think that's going to get it. He manages 2.4 trillion assets in fixed income for BlackRock. Scott Bessent, the Treasury Secretary who Trump picked, also had a similar type background. Huge fixed income guy that knew markets and knew markets very well. This guy's no dummy. He's a very smart guy and has the experience. 2.4 trillion in assets under management. I think Trump's going to pick him. One, he's very dovish. He is, every time he gives a talk, he's talked about doing rate cuts. So he hasn't flip-flopped. And he's got the experience. I think that's who Trump's going to pick. If you get this guy in, and you've got Bowman, that is now in the rate cut camp. You've got Myron, rate cuts for sure. He's worked for Trump in the past. This guy, rate cuts. You've got 4 dissenters. Plus, if this guy gets elected and he's now the Fed chair, you're going to have 5 people now that are out of 12 that are going to be big, or 19, that are going to be for rate cuts. So it'll be very easy to sway once you get this guy in. And for that reason, I believe this is going to come down further. I think these guys are going to help influence this. This is going to come down to the 250, 225 mark. And if you have any kind of recession or any kind of further weakening unemployment, you can certainly expect this to go down. I don't expect it to go up, meaning if I'm buying this down here, the ZQZ, which represents this 12.9 number, this is not going to go any further lower than this, maybe just a hair as far as bounce down and come back up. But with this thesis that I've just laid out, you're going to see this guy climb up to the 97.50. If this closes at 250 here, 2.5, this is the inverse, so it'll close at 97.5. which is, it's at 97.03 now, which is another 50 basis points. Each basis point, $41.67, and it takes $2,000 to hold one of these contracts. You have to be approved to trade futures. Put a small amount on that if you believe it's going to go up like I do. I am long on this, absolutely long on this, and I may even go out later and buy April or June or May, somewhere along in there of 2027, because I think we have a very strong case for lowering rates. Okay, with that, let me show you DHI, DR Horton, and then we're just about done. DR Horton, look at this stock. This is the stock here. This is mortgage rates here, and this is DR Horton's PE ratio here. If you go back and when rates go up, does not do well with DR Horton. DR Horton is one of the biggest home builders in the country, and they produce a lot. But as rates go up, people don't buy houses. When rates go down, the stock goes up because there's thought that people will be buying more houses. We just looked at, I think rates are coming down, so I think DHI stock is a good stock for it to go up. And take a look at the correlation here. Rates going up, stock comes down. Rates go down, DHI stock goes up. Let's go back into September of last year. Rates really fell and the stock really rose. And so when I'm talking really fell, the mortgage rates was like 6.1, and yet DHI stock went up to 200. And then look down here, it fell back because rates started going up, back up to like the 7%. We're now in May. This is back in January. So in this time frame, we're like teetering between 6 3/4 to 7 on the rate, and DHI stock did not do very well. And then look at the narrative shifted, and hey, rates are coming down. So we dropped from that 7% mark, and we got down to about 6 1/4, and DHI stock did very well. But the reason why DH stock came back down, even though with rates being hovering around that 6 and 6 1/4, is look at the PE ratio. It didn't like the PE ratio. The PE ratio got too high. The price to earnings, meaning for its income that it brings in, the price was too high. So it got up to 15. Here it is, 15. And if you look back here, when it got up to this previous high, it was only around 13. So this is why this time it fell a lot. So I think this is a good candidate. What I am personally doing on this one is I am selling puts down in this range, maybe 130, 135. I'm selling puts here so that if it comes down further, which would put the PE ratio at right now we're at 11 point, 12 and a half. Then that bringing it into this range puts it around 11, which is not bad from a value perspective. And then I'll collect premium in the meantime. So I think this is a good candidate just based on we know rates are coming down. If rates come down, DHI stock's going to go up. And their PE ratio supports it because it's not in that 15 range. If it was in the 15 range, based on past when it gets up really high in that 15 range, you got to look at the price. You got to look at where rates are. We know with rates coming down, the PE ratio is in a good spot. I believe DHI will be a good buy. One last thing, look at the PE ratio just over time. This is compared with Lennar, the second largest home builder. Both of them are in very good shape. They're both doing buybacks. Their PE ratio is 12 and a half, which is good for a stock that's on the stock market. And DHI has $2.6 billion worth of stock repurchases next year. That's very supportive of stock prices, meaning they're buying their stock back at cheaper prices. They believe in their stocks. They're buying $2.5 billion worth. Lennar's doing the same thing. They're buying about $500 million worth of their own stock every single quarter. So that's just money back into shareholders' hands. You're taking shares off the market, basically, and it makes the stock more valuable. So for that reason, I think either DHI or Lennar is a good buy. We know the housing demand is very strong, and when rates fall, it'll definitely be a positive. All right, so what do we have coming up this week? Really, not a whole lot with Thanksgiving. We're getting PCE, it looks like, and some real estate data. PPI, I don't know that I'd put a whole lot of stock in PPI retail sales, given the government shutdown and data collection and stuff. We'll see when it comes out what happens. But I do expect this week to be a pretty light week with Thanksgiving. A lot of people take off, and volatility should fall this week, which I will sell some options on that and take advantage of that. And then finally, volatility crush. So last week I mentioned several candidates to play over earnings. I ended up only picking 3: Target, Lowe's, and Gap. Target, I ended up making 71% on that trade. Lowe's, I ended up losing 32%. I had twice as many targets, thankfully, than I had Lowe's, but the target position definitely outweighed the Lowe's position, and then I ended up working into Gap and made 63% on that overnight. And of course, you're not betting the farm on that. You are only taking small positions on these, and you're doing a bunch of them, and then you're making this kind of return. That's a pretty fun little play. If you want more information, please let me know, and I'll do a video on earnings crushing in much more detail. All right, so for this week, this is what I'm playing from a volatility crush perspective, or these are the candidates that I will potentially play. I will probably play Best Buy for sure, Dell, HP, maybe Western Digital, maybe, and then Kohl's. Retail has been pretty good to me from an earnings crush perspective. So this is what I'll be playing, and I'll report back next week. If you want to know how I'm playing that and you want the detail, please let me know. I hope you enjoyed this video. Happy Thanksgiving. Remember, the market is shorter this week. It is closed on Thanksgiving Day, and it's a half a day on Friday. So with that, happy trading, good luck, and we'll see you next week. Thanks.